Champions School of Real Estate. Wonderful students, wonderful instructors, wonderful staff. I'm Rita Santamaria. I'm the owner, the founder of Champions School of Real Estate, and it's my pleasure to be with you for the next hour and to bring you our wonderful, informative, smart Dr. Jim Gaines from the Real Estate Research Center at Texas A&M University. First of all, I want to most definitely say hello to Plano and Fort Worth, all of our campuses there, all of our students there, as well as Austin. And Austin, you know, we're going to be opening, I think we will be open for students the second week in February is what it looks like. And we have a wonderful facility. It's for you. It's to make sure that you have the wonderful Champions Advantage experience. So we are thrilled to have the new Austin campus where we can combine the online department as well as our campus and students together in one beautiful building right at 620 and the 45 tollway at 183. So when you see Lifetime Fitness on that tollway, we're right next door. San Antonio, good to have you here. Hello, San Antonio. And then most definitely Houston, where we have our North Campus. North Campus will be relocated this time next year, actually by fall of 2019 on the Grand Parkway. And I am just as thrilled as all of our instructors are that our people in the North, especially the Huntsville, Kingwood, Centerville, 290, they can all just come in on 290, hit the Grand Parkway and be at our new campus. We have our beautiful Galleria campus where Dr. Gaines and I are today. And we have our live studios for those of you that want to be in a virtual classroom. Another hello to the president of our company, Kimberly Didelowitz, who lives in Georgetown, and she'll be officing in the Austin campus. We are so fortunate because she's there on site and has been just the most wonderful project manager for the Austin location. I was telling Dr. Gaines that last year when we had our 2018 update, how that our instructors were able in CE, our part of CE, the elective, to have Dr. Gaines do his update, and the students were so positive, so appreciative. The instructors said, well, can we get Dr. Gaines back mid-year? So we had you in August as well. Right. And now to be able to kick off 2019 and look into your crystal ball and see what we can expect for the next year. So I want you to be sure at every opportunity when you see that anyone from the Real Estate Center, from Texas A&M University, it's part of the Mays Business School, my goodness, so much credibility, so much information. Whenever you have an opportunity to hear any of these fine PhDs speak, it is an opportunity not to miss. Dr. Gaines specializes in housing markets, development, and he's sort of become a household name in the real estate industry in Texas. So I wanted to make sure we had plenty of time for our Dr. Gaines update today. And without further discussion, I'm going to turn it over to Dr. Gaines and let myself enjoy the good information that he brings forth to us today. So Dr. Gaines, what are we looking at for 2019 and how are you doing?
Well, we're doing fine over at the center. Thank you.
Good.
And it is a pleasure to be here, and Happy New Year to you and to everybody out there. We'll start out 2019 as strong as we can and see if we can keep it up.
Keep it up. That's our goal.
That's the goal. We've had, for those of you just quickly who might not be familiar with the center, we're now 48 years old. We are funded by the licensees in the state, which means that you are all my boss. or soon to be my boss as you get licensed. And I wanted you to know recenter.tamu.edu. That's the website. Everything we produce and everything we do, we make available. And the cost is great because it's free. Just go out on the website. You can see up there in the top where I've circled in red. If you click on any one of those, you can get data, you can get research reports, so forth. That's just a screen capture of one of the pages. It's already gone. That's already a history, but because it changes about every 3 or 4 weeks. But you'll be able to see it. Market research for those of you around the state. If you're looking for information and data about your market, we cover all 26 MSAs in the state. Click on any one of those, and it'll come up and give you links of where to find all the information that we have, ours as well as anybody else's that might be of interest to census, labor data, et cetera.
I'm just thinking for a new person going into the business and needing to put their listing packet together, to be able to click on the metro near them and pull off free information is such a gift.
Well, and in one I don't have a picture of, there's a 2-page summary report that we update every month. That shows the monthly information, employment, but home sales, price levels, et cetera. That's under the market reports under that research. If you go back to that previous slide, if you look under research there on the left and pull it up, it'll be market reports.
Right down that website.
So that's the website. That's the reason I had that as my lead slide. Perfect. That's my commercial.
That's I love it. We need that.
We like this.
Otherwise, we get emails after you're finished.
But everybody here, that's one of those sites that you really do need to know about and be able to get to and access and find the information. And if you can't find it, if you're looking for something and can't find it, call us or email us. And we have an open email info report, and one of us will respond. It generally gets allocated to whoever's area it might be. If it's rural land that you're interested in and so on, it will come up and go there. Well, let me get on into it because I've got a lot I'm going to try and share with you here in a fairly short period of time. 2018 turned out, and we think is going to turn out when we finally get year-end data. We don't have year-end data. We really won't until about February or so.
It's January 8th.
Well, I know. But it's interesting.
You work fast, not that fast.
It's interesting how in a couple of months we will still be getting reports of sales that occurred in November and December. So we try to update. But anyway, the U.S. economy is doing well. The 18 is going to finish the year with GDP around 3.1. The key, I guess, I'm going to give you, this is going to be a recurring theme of the whole discussion this morning. 19 is going to be a slowdown. We are not, and I'm going to say this about 4 times before this is all over, we are not expecting a recession this year. We're not expecting a collapse in the economy, but we are expecting it to slow down, both at the national level, at the state level, and at most of our major metropolitan areas. We'll get into more detail about that. So what I'm showing you here is 18 is going to finish about 3.1. 19, the projections right now around 2.7, 2.9. So you can see it's slower, but it's not a real big fall off. It's just that way. Jobs are still expanding at about 1.5%. This is at the national level. If you're familiar with the information that just came out last week, we gained over 300,000 jobs in November.
That was the
which is terrific.
Letter that just came out.
Yes, that was the best in about 1.5 years or 2 years in terms of a monthly gain. Ironically, the unemployment rate went up, which was a good thing, because what it really meant was not more people being unemployed, it was more people looking for work. So the labor force was growing. So that makes the unemployment rate go up.
That's a good point.
The interest rates, and everybody in real estate, of course, always wants to talk about interest rates. As you well know, this latter part of the year, the second half of the year, the interest rates started going up. The Fed did increase the federal funds rate in December by the 1/4 point that everybody was expecting. The irony was, though, that the Fed did the rate hike, but the long-term rates, the 10-year and the 30-year mortgage rate, actually came down in December.
Did.
So it went opposite.
See that news.
And to tell you the truth, the interest rates right now are going to be one of those things for the coming year that everybody's watching. The financial markets are in uproar a little bit because last month there was a slight inversion of the yield curve. What that means is short-term rates wound up higher than long-term rates. If you think about it, if you lend money for a longer period of time, you generally want a higher interest rate because there's more risk over time. So short-term rates should be lower, long-term rates should be higher. Well, when that reverses, it's called an inverted yield curve. That's what that is.
And what causes that?
Well, there's a number of things that cause it, but generally it can be either a recession, although quite frankly in the economic world, the inverted yield curve is generally a leading indicator of a recession yet to come.
Okay.
Generally a year and a half later. Well, it wasn't the whole thing. It wasn't across the whole spectrum. It was the 1 month got higher than the 5 month. So it was and it only lasted for a while. Yeah. So it was repositioning. Some of this was the Fed's raising of the federal funds rate in December, and they announced earlier in the year they were going to do 3 more rate increases next year. They've already limited that now to 2, and the odds are they might not do any. We for sure don't think they're going to do any the first 6 months, but we'll have to see how that goes. I got a couple of charts here. We'll talk about interest rates. Inflation is going to be around 2.5%. We've been running less than that for the last 6-7 years, but it's up to that level or a little better, and probably is going to stay there. The tax cuts that we got at the beginning of last year helped last year. They're beginning to phase out, or they're not having the impact on the economy that they did. Industrial production is still high, but our manufacturing sector is doing really, really well. But it's not labor intensive. It's not adding the jobs like we used to get. It's because of capital investment, robotics, artificial intelligence, all of the things I know we're talking about in the real estate area as well that are coming into pass. Well, it's part of the industrial production as well. Income is growing. People are making a little more money. PCE, that's personal consumption expenditures, are up a little bit, and that's one of the things the Fed watches. The housing market nationally, it's not generally understood, but nationally the housing market has never really recovered from the 08-09 recession. Not completely. It's never gotten right back to that level.
Are you saying, I know in other states it hasn't, are you saying also in Texas?
Texas is I'd say nationally, the national housing market. And the last quarter, the last 3 months of the year, the housing market nationally has stalled out in terms of increase in volume of transactions and price increases. We've even seen a little of that in Texas as well.
So what makes me want to state is, yes, if there is a bit of a slowdown in 2019, you really need to be very thankful that you are still in Texas.
Oh, yes. Oh, yes.
That slowdown as an agent, as a broker, will not affect you as much.
No, we're expecting a little bit of a fall off in Texas, but we're falling off from record highs. Some of the other states in the union are actually going to show statistically some growth, but that's because they fell so low that they're still not recovered.
So at this point, which year in the last couple of years was the all-time record high?
18 is going to be the record high.
It's going to be the record high?
Yeah, okay. Yeah, we'll get there. I'll show you that in a few minutes.
Okay.
Here's what I was talking about with the interest rates. The green line there on the bottom is that federal funds rate that the Fed increased the rate to 2.5, their upper limit in December. That's right there at the far right of that. But you can see the blue line and the black line actually fell off. That's the 10-year Treasury, and then the black line is the 30-year fixed mortgage rate reported by Freddie Mac. So you can see, ironically, while the Fed has been trying to increase the short-term rate, the long-term rates are actually coming down.
The one we care about is that 30-year.
That black line, that's the one we care about.
And that was great news that we all realized maybe yesterday.
Well, we knew that last year we entered the year, the 30-year fixed rate was right around 4%. It was fluttering just a little above or a little below. And by the end of the year, I know here in the Houston market, we hit the 5% mark by the end of the year. So it did show some creepage upwards. And my guess is In fact, I'm fixing to give you my guess. Here's my guess for this coming year. I'm not sure I want to call this a forecast, a projection, or anything else other than a guess. But I think that we're going to see interest rates this year run probably between that 5% or the low or high fours, 4 3/4, 4 7/8, up to around 5.5.
And as we said last year, talking about those rates still, when I have the history of being an agent, where if we had a 10% rate, we were happy because we had just come down from the 15. So looking at 4.5
or 5 or even 5.5 by historical standards. In fact, you can see on the far left there on that line, you can see where interest rates were just in 2007, 8, 9. In fact, we had our biggest housing boom between 2003 and 2007 when the mortgage rate averaged 6%. So we don't have to have 3% money to have a good housing market. And you can see it's going to go up a little bit.
That history.
And that's a guess. And that won't be a straight line like that. I don't know what the month-to-month variations are going to be on that. I wouldn't be surprised in the next month or two, they actually continue a little bit of downward slide and then bounce back up a little bit. But that's, the market determines interest rates. The government doesn't, the Federal Reserve doesn't set interest rates. It's the markets, people borrowing money, the lenders lending money, and how much supply and demand there is for borrowing money that sets those interest rates.
And you know, we have some of our finance students watching today.
Right.
So the information you're giving them is very helpful in their finance class.
Well, and as anybody who studies finance and studies it, the worst thing you can do is try to predict what interest rates are going to do. You're either a fool or a liar. So you guys can take your pick of what I am here with these projections. But the best outlook right now, and for planning, for thinking about what's happening and how you're going to go about your business for this coming year, be thinking in terms of interest rates being in these general areas without being too specific about it. In general, when we move and get away from the national economy and talk about Texas, we had our oil decline in 14 and 15. It carried over into 2016. So as a state, we actually had a little bit of a slump in 15 and 16. 17 was a good year. 18 turned out even better than 17. 19 has some headwinds, but we think it's still not going to be a bad year. It's going to be touch and go. Here's for example, for this past year, just to wrap up 2018 a little bit as best we can. We are rebounding from Harvey here in the coastal area, in the Houston area and up and down the coast from Corpus up to Beaumont. It started out pretty strong. The recovery started out strong, but it seems to be dragging out now, which is not surprising. I don't think
we did everything on the front end as quickly as possible. Right,
but yeah, I mean, I don't think they've really rebounded in New Orleans. So rebounding from Harvey is coming around. State GDP is doing great. It was around 6% at the second quarter. I got to tell you, 2018 is a tale of two halves of a year. The first half of the year was really strong, really terrific. Third quarter was pretty good. Actually, was very decent. The fourth quarter fell off. So we saw the strong growth in the early part of the year, and then a tail off toward the end of the year. Part of that was the oil prices. Until about the fourth quarter, until about September, October, oil prices were running close to $70 a barrel. And as you know, right now, they're running about $40 to $50 a barrel, which incidentally, we think is going to be pretty much where they're going to stay for this year. Okay. We don't see them coming back up to that $70 a barrel.
And is it about $60 a barrel that we like, or what is the rule of thumb?
Oh, there are a lot of rules of thumb.
Okay.
There's a lot of rules of thumb. Our analysis is that $40 to $50 a barrel is good, decent, but not robust. When it got to $60 or $70, that was pretty robust. Anything better than 70 was going to be very, very good. The rest of the world, Saudi Arabia, Russia, Iran, Iraq, all of the other major producers of oil in the world would really love for the price to be a lot higher. Their target is really 80. to get it back up to 80. The trouble is the global economy has not been growing fast enough to create the demand for oil to keep the prices at that level.
Good information.
And if you're not aware of it, for those of you around the state, the United States is now the #1 oil producer in the world. We now surpass Saudi Arabia, we've surpassed Russia.
That's huge.
And the big player in that is the Permian Basin out in West Texas. And our production is has gone up the roof. I think I've got a slide here for a little bit. But we are now producing a lot of oil. And in fact, the Saudis just announced here within the last few weeks that they were going to cut back a little bit on production, but they're not going to be able to influence the price enough. They used to be able to control that price or move that price. They can't do it anymore. I'm
going to ask you one follow-up question to Harvey before we go to the next
Sure.
slide. When you were here in January, we were definitely talking a lot about Hurricane Harvey and how it affected the coastal area. Can you tell everyone, typically the general public will get over that disaster when they're looking for property, and how many years does it usually take for their minds to sort of forget about that?
Yeah, the history has been that when we've had past hurricanes that have hit, and we've had some pretty good ones. We've had some real good ones, Ike and Rita and others on back past. It's generally taken 2, sometimes 3 years.
Okay.
It's a human phenomenon that people like to live by water. Rivers, lakes, oceans. And the history of mankind actually followed water, oceans, rivers, because that was transportation, among other things. Now it's for aesthetics and elsewhere. So it does come back. It takes a while. For those of you who don't understand, the Bolivar Peninsula was wiped out with Ike back in 2008, I think it was, and has been rebuilt and got rebuilt. Even though now the insurance programs and the insurance plans, the FEMA programs, that's an obstacle that has to be overcome and to be able to get the insurance or be self-insured. So the Harvey rebound is coming. It's still having effect. We're still seeing it here in Houston in some of the neighborhoods along the bayou.
Definitely.
It's not. It hadn't gone away yet. Those pricing influence and the marketing influence. I'm sure agents will tell you that one of the first questions a buyer in Houston asked, did this house flood?
Oh, absolutely.
And if it did, how badly? Which is sort of the follow-on question. So anyway, last year we added over 350,000 jobs in the state of Texas.
Remarkable.
I mean, it's just remarkable. It's really good. Outlook for 2019. I've got 2 slides on this. It's a tale of 2 cities right now. In fact, I just read 3 economic reports in the last week, and all of them had the same theme. By and large, all of the economic data that we follow, jobs, employment, industrial production, price levels, just about all of it that we follow is positive. And it's all indicating good, strong economy, good, strong year. What the flip side is that there's a lot of uncertainty going on. One of the things that's showing up specifically is the stock market going down so significantly that last month and the tremendous drop there. And other political actions. The uncertainty, like the trade agreement, the wall, the fact that the government technically is shut down, and nobody seems to know when it's going to reopen. I understand there's a speech tonight from the leader to tell us about it and why he wants the wall and all these. So all these things, it's strange when you have a situation, and it makes it really difficult for people in my profession to get a handle on, where the data are telling us positive, but some of the softer outlook is saying, well, wait a minute, it won't be that positive.
All these things are happening.
All these other things are going on over here. So we have to watch. So here I've got, for example, U.S. economy is going to stay strong. We're expecting the U.S. economy to do well. And incidentally, that's the #1 factor helping Texas. We avoiding a national recession this year is probably the #1 issue that we need to do. in Texas to keep Texas going along. And we'll still continue to be even stronger than the national economy, but that'll be good. Employment is going to run 2.5% to 3%. Our GDP will probably fall off from about 5% to 4% in round numbers. The energy sector is going to be volatile. There's a lot of uncertainty there. If oil prices will stabilize between 40 and 50, stay in the mid 40s or close to 50, we shouldn't feel too badly there. I can tell you the futures market, we were just looking at this yesterday, as a matter of fact, is telling us that they don't expect the prices to go up. The futures market, you can't sell a barrel of oil today for a 2-year delivery for more than about what its current price is. Okay. So that tells you that the traders are not looking for prices to go up. And in fact, it's been a very steep decline in the last 4 months on that. Population is going to continue to grow, and it's growing strong, but it is going to go a little slower. 2018 population growth was a little slower, than 17. 17 was a little slower than 16. We've had a run of about 4, 5, 6 years where we were just doing phenomenal. I mean, just phenomenal. And what we're doing is it's a slowdown to more normal.
I was going to say it is more normal.
It's reversion to norm is the economic term, but it's not a bad thing because you don't want things to be bubbling so high that long that you can't sustain it and continue. Exports are doing well. Trade agreements and uncertainty. Whether we have an agreement with China or not, who knows yet. The Mexico-Canadian trade agreement has not been ratified by Congress, so that's not in effect. We're still operating under UNCTAD, or NAFTA rather. Retail sales are steady, but not significantly higher. I saw where the comptroller came out this morning or yesterday and said we're going to have a little budget surplus for the legislature to work with, but it's not going to be enough that we should get real excited about. And even that is a little shaky probably, and I think they know it. On the downside, U.S. and global issues, the greatest headwinds are from psychological impacts and counterproductive political actions. These other things going on that don't show up in the economic statistics yet. Stock market sell-off is actually one of the reasons why those interest rates went down in December. When the stock market fell, the investors, the equity investors, were getting out of the stock market and going and buying bonds and fixed income assets, raising the price, thereby lowering the rates.
I would love to have taken an economic class from you.
Well, okay.
It's such good information.
It all fits together. It's a big jigsaw puzzle. It's a big jigsaw puzzle.
And what I love about you give examples, which is great for people to understand.
Well, that's what's happening, and it's happening around the world, not only just in the United States, but it's happening around the world. England right now is going through a really hard period because of this Brexit. They've got a plan, but nobody knows whether this plan is going to work. And nobody knows what it's going to really do to the economy of England. They don't know what it's going to do to the economy of Europe. And Italy and France are not far behind. Italy's broke. France doesn't have a clue. But so we'll have to see. There's that yield curve I was mentioning a minute ago. The low and middle levels created uncertainty because for a short period of time, they went opposite the way they were supposed to be. They kind of balanced back out again, but the financial markets, the Wall Street, the guys investing, the stock market gets real nervous when those things start moving around like that. They want it to be norm. They also want it to be reasonably consistent with little volatility and uncertainty. The thing that affects the real estate market, all markets, the economy the most is uncertainty and not knowing what's going on and what's going to happen next. The housing market's gotten softer. New construction is flattening a little bit. Unaffordability or affordability is a key thing. All of the
I don't like that unaffordability word.
Yeah, well, I didn't know how else to express it. Higher affordability implies that people can afford. Now it's the other way around. Yeah. So, and then the global economy has done well. 2 or 3. Europe, I was mentioning, is down a little bit. Japan, of course, has been in a recession or flattening for the last 10 years. China is growing about a half or less of the rate that it was growing. And China is the emerging force in the global economy. Just too many people, too big. The U.S. economy is still the world's largest and most important. But China is a fast-growing number 2. Here's what being said, though, and I found these, and I thought we'd like to see them. Wells Fargo Bank came out with their thing on Texas. It's going to continue to benefit from many of the same factors expect to drive north. That's why I was talking about if the national economy continues to do well, Texas is going to continue. And I highlighted the momentum in the non-energy part of Texas. Don't get too hung up on the price of oil. Yeah, it's important. And yeah, especially here for the Houston area, very, very significant. But from the statewide perspective, our non-energy sector is actually much more significant as a proportion of the total economy of the state. And it is still doing well and still benefiting from the growth and economic expansion.
In this last week's letter from the center about the Dallas construction, like 35% up.
Yeah.
And you look at the other economies around the state and see how great they're doing because we did diversify.
We have. Dallas, for example, we did an analysis a few years ago. We discovered that the Dallas-Fort Worth Metroplex economy is correlated to the national economy extremely strong. It's like 0.93 or 94, very strong. Houston, by example, or contrast, is 0.77 because of the energy dominance here. That isn't the dominance at the national
the DFW
level.
area.
Right. So DFW and Austin, for example, is not energy. I mean, I know I talk often up in the Dallas area.
Is it mainly technology in Austin? What is your opinion?
Technology, government, high tech, particularly, and population growth, which is bringing in small businesses, small companies. And DFW, same thing. They've had a number of the Fortune 500 companies relocate their regional and national headquarters there. Entrepreneurship is rampant in Texas. We're very entrepreneurial state. We're very business friendly, so creating a business and starting a new business is much easier here and less costly than in most other states.
So for the San Antonio region, what really pulls that economy?
San Antonio is interesting. San Antonio historically has been military and tourism, but now it's got a good manufacturing base. Toyota came in a few years ago. Some other smaller manufacturing has come in. Business services are growing in San Antonio. So that regional coverage of San Antonio expanding. And up and down the I-35 corridor. If you've driven from San Antonio to...
Well, and you don't drive too much. Sit in traffic.
It's complete. It's very commercialized. I mean, retail is obvious, but all of the other businesses, smaller businesses, medium-sized businesses up and down the corridor, and now spreading out from there. So we'll see. Texas leading economic index. You can see the little bit of downturn there on the far right. That was that fourth quarter of the year. Was not quite as robust, not quite as solid as the rest of the year. But 2018 for the whole year was pretty good. Here's what the oil and gas looks like. And what you can see in the orange line there on the far right, the fall off, where it's gone from nearly above $70 a barrel down to below 50 and into the 40s.
And we don't want to look at the black line there.
Well, the black line is the rig count, and the rig count is interesting. We anticipate the rigs now are so much more productive than when the fracking first started. Fracking was a brand new fracturing, oil fracturing, shale fracturing was brand new in 2008, all the way through 12. It took 4 or 5 years to really get it going and so on. Well, the average well in those days, the new wells being drilled, were producing anywhere from 20 to 50 barrels a day. Well, today a new well is producing anywhere from about 1,100 to 1,300 barrels a day.
My goodness.
So we just don't need as many wells. We just don't need them. So that we're expecting, as you can kind of see there on the tail end of the black line, is sort of going level. I mean, it's got the variability on a week-to-week basis. These are weekly data. But the price falling off down to below 50 will probably bring that down. There'll be fewer wells started. The other part of this is that about half of the wells being drilled today are called DUCs. They're drilled but uncompleted. They're drilling the shaft down and the horizontal shaft, but they're not actually then completing the production process of fracturing the shale and drawing the oil out. They're leaving that for later. And so if the price ever does start coming back up, we'll increase production by opening. We're ready. We got a whole bunch of these wells. Nobody knows exactly how many we've got. The best guess we've seen is it could be anywhere from 3,000 to 6,000 of these wells. It's a lot.
That's appreciable.
It's a sizable number. But this is what the picture looks like. We think we maybe it's more hope than think that the price, that decline you're seeing there from 70 down into the 40, 50 range is going to even out a little bit. The production, though, even with all of that going on, the production levels in U.S. production, we're now producing something like close to 11.5 million barrels of oil a day in the United States. That's number one in the world. Texas is producing just about 40% of that, of the total. When we become an independent nation again, we'll be the number 6 oil producer in the world. Is the state of Texas. Yeah. So it's been phenomenal. And despite the price coming down, the production continues to go up. Now, the other thing that's happening here this year in 2019 is where there's a series of about 8 pipelines that are going to be completed this year. I don't know if all 8 get completed this year. I know several of them do. That's going to increase the flow of oil from the West Texas fields into the refineries here on the Gulf Coast at Corpus and in Houston and into Beaumont. So, and
that's why all of those ports and the refineries
they're all going to gear back up again. So the downstream is going to pick back up again, even if the upstream energy slows down a little bit. Jobs, we're looking, jobs grew about 2.9, just shy of 3% this year. We're looking for about 2.7%. We're averaging about 267,000 jobs a year. But like I said, last year we added almost 350-something thousand. So, you can see the last several years. You can see the slowdown in 16 and 17. That was when the price of oil went down. But we're back up. And so 19, right now, when we look at the data and what we're expecting and anticipating, unless something major happens on that political uncertainty or something that would cause the national economy to disrupt, we're pretty confident in that number. You can see the growth rate in employment in Texas has bounced right back up since that 15-16 downturn from the oil collapse. It probably won't sustain at 3%, but 2.5 to 3, somewhere in there. Here's what it looks like the last 8 years, 9 years in terms of growth. Jobs, this was a record, not a record year. 2014 was our biggest year, but a substantial year of job gains. And you can see the population growth. We've added nearly 4 million people to the state's population since 2010, which bodes well for the housing market. Basic rule of real estate, teaching real estate for a number of years, everybody's got to be somewhere. And those 3.8 million people, that is the increase. Now, about half of that natural increase, that's births over deaths. And I'm happy to report that the death rate is down.
I saw that the births exceeded deaths.
Births are exceeding deaths, but actually the birth rate down, but the death rate is down. So as an older person, I'm happy to say that. And we've added nearly 2.5 million jobs in that same time period. Here's what it looks like. We keep getting bigger. 8 of the top 15 largest gaining counties are in Texas in 2017. I don't have the 2018 numbers yet, but you can see Harris was the largest growing in Texas. Maricopa, that's Phoenix. And Clark County, that's Vegas in Nevada.
Well, when you said we added 4 million people in Texas, I was going to say that's like adding another Houston all around the state, which is...
Well, actually, Houston's bigger than 4 million. Yeah, but yes,
well,
it's a big metropolitan area.
So 8 of the top 15.
Right, and that doesn't have, for example, Williamson County, It doesn't have north of us here. We have Fort Bend, Montgomery County, which were in the top 20 or 25, but they didn't make the list of the top 15. So you can see just how we're dominating some of this. Here's the by county where the population change has occurred since 2010. The red counties and the dark orange are the fast-growing counties, and you can see it's going right up I-35 up into the Metroplex, and then the urban triangle of Dallas, Fort Worth, Houston, San Antonio, Austin. That urban triangle is filling in. 87% of the people in Texas live east of I-35, of the I-35 corridor.
That's amazing.
Yeah, yeah. Well, you can see the light-colored counties out in the middle part of the western part. Those are counties actually are losing population. So it's not universal in the state that every county is growing.
I've never thought of it as east of 35. I've always thought of it as the Texaplex, that uneven triangle.
Right.
Incorporates.
Well, 2/3 of Texans live in the urban triangle. 2 out of 3 Texans live somewhere in that triangle that's defined. Now, El Paso is growing. Midland is the red county out there in the west. You can see Hidalgo County down San Marcos. McAllen. So you can see where there is some other growth, but it's filling in around. There are even some counties, though, in East Texas that are still losing population. It's interesting over there. You would think that they would not be.
Well, I'm looking at Beaumont and that area,
right?
Which is really growing.
It's going very well. One of the other things that I-35 kind of defines in a general fashion, the demarcation between where we have water problems in the state and where we don't. East of 35, and particularly along 45 and east, the water issue is not as significant in terms of availability, but anything west of I-35
is a problem.
It can be a problem of water accessibility, potable water, and so forth. And there's the urban triangle we're talking about. Here are the projections. This is from the State Demographer's Office. We're projected to grow from somewhere around 25 million, which was the 2010 census number, to somewhere between 40.5 to 55, 54 million people. It's remarkable. From 1970 to 2010 on the graph here, we added about 14 million people from 2010 to 2050. The next 40 years, we're estimated to add between 22 and 30 million people. That's a lot of people.
What?
That's more than double our current, the population in 2010.
Also.
Yeah, if we add somewhere between 22 and 30, we're virtually doubling the population of the state from 2010. And the current growth line is that 2010, 2015. It's the purple line there in the middle. That's the current. We're not quite hitting the same rate of growth that we did between 2000 and 2010. But we're much better than 50% of it, which is the green line. So it's kind of the in between.
This particular slide alone is so good for an agent when they're talking with buyers and sellers. I mean, it just shows the projection. It allows them to not have to say what they expect is going to happen with the economy or with the population. The chart says it all. Yeah,
and like I said, this came from the State Demographer's Office. There are different projections. The State Water Development Board has a different projection and 2 or 3 others. The Census Bureau has its own projection. So you can get different projections, and some of you will hear different projections. Cities and counties might do their own projections. We just simply use, by default, the State Demographer's Office for ours. Here's the 2010, 2050. That's that 22 to 30 million people by county. It's the same counties. It's the same growth pattern that you can see again into the urban triangle. Again, we still have counties in the state, though, that even over the next 40 years are still projected to lose population. You'll find that these counties will have a higher concentration of older people. They're losing their young people.
Okay.
I mean, if you're living out in one of those counties, you're 25, 30 years old, unless you're running the family business or the family farm, what do you do? So you're probably going to one of the major areas, and we are an urban state. Excuse me.
You're going to move east of 35.
You can probably move to one of the urban areas. That's where the jobs are. We are an urban state. Despite the fact that Texas has the largest rural population, numbers-wise, of any state, percentage-wise, we are very definitely an urban state. So it's very much there. For some of you, here's the Austin MSA. Now that's the 5-county area over in Austin, projected to go from 1.7 million in 2010 to over 5 million. I don't know where you're going to. Incidentally, with growing by about 3.5 million people, that's a growth of about 3.2 million more cars and trucks. I don't know where you're going to put them. I don't know where you're going to park them, much less drive them. So, but it's a over 200% increase. It's a tremendous amount of increase going. Dallas-Fort Worth is projected to be over 16 million people by 2050. Now that's the DFW, that's the Metroplex, and that's the multi-counties. You can see them listed there.
At some point, the hope would be that we separate Dallas and Fort Worth. Fort Worth is such a growth area on its own, and to always combine them, getting those stats.
The Census Bureau has.
Sure.
Dallas-Fort Worth is the only area in Texas that has what's called municipal divisions within the MSAs, where they've separated Fort Worth and Dallas. The irony is they put Denton County with Dallas. And if you look at a map, it looks like Denton County ought to go with Fort Worth, but the Census Bureau and the official demarcation of the areas put it over with Dallas. So anyway, it's just, anyway, it is what it is. But adding nearly 10 million people in the next 50 years, I mean, is a remarkable. And that's the momentum that Dallas has built so far and is expected to continue. Dallas, Fort Worth, the Metroplex is attracting so much of the economy of the U.S., so much attention, and it's the reasons are not altogether clear. It's a transportation hub, major airport. Despite the fact Amazon didn't pick it for HQ2, Amazon still built a 1 million square foot facility up there. In fact, I think they have 2 of them. It's a central time zone, which works very well. Cost of living. The people in Dallas-Fort Worth will tell you the housing costs have gotten high, but relative to all the other major cities in the United States, it's still very affordable, as is Houston. And after all, DFW is the number 4 MSA in the country. Houston is the number 5 MSA in the country to go. And here's Houston is projected to be over 14 million people, to have gone up from about 6 million.
And that includes all of those counties.
That includes those guys. The MSAs, the Metropolitan Statistical Area.
Austin, Brazoria, Chambers, Fort Bend, Galveston, Harris, Liberty,
Montgomery and
Waller.
Right.
We have wonderful students in all those areas. And if you're having any difficulty seeing the charts or graphs on your computer right now, in the classroom or at home, as Dr. Gaines said at the beginning, that website that you have, you can bring these right down to your own desktop. They're great pieces of information to have.
And I'll make it available to you so you can make it available too. So everybody can get a copy of it. San Antonio, the growth is double. It's not quite as percentage-wise the same as DFW, for example, but San Antonio has been just a remarkable market for the last several years and is showing tremendous growth. Let's turn our attention to housing before we run out of time here. 18, actually it was more than a very good year. It was a great year for housing around the state. Sales are going to be up a little over 2%. That's our best guess of what the year-end numbers are going to look like. Now, it might be a little bit different, but it's going to be in that ballpark of just under 2.5% increase, which is a slower rate of increase than we've seen the last couple of years.
But it's an increase.
But it's an increase, and that means 18 is now the record year. It'll go down as the record year. Average days on the market was 57. Months inventory is still tight. It's still 3.7.
It's a great month's inventory.
The month's inventory balance market for the whole state, according to our analysis, is about 6.5. So 3.7 is still a very tight market. Incidentally, one of the reasons that we think the sales volume didn't go up more is because of shortage of inventory. It's not because of fall off in demand. There's still a lot of people out here who want to buy a house, who actually have the capacity to buy a house. They have the financial capacity.
But not as many homes.
They can't find the house they want. So now they're sort of saying, well, you know, I'm going to wait and see if I can find the house I want. I got to tell you, the prices, though, are still, as you can see, the average price went up 4 and the median price 4.5. That was a little slower rate of increase. In fact, that's almost normal. Somewhere around 3.5–4% a year is the normal rate of increase for home prices.
Well,
so that's not
price
power.
to go up 4.5. That's a very good.
It's a very good rate. So home prices are still going to, because of the shortage, it's basic economics. Supply is short, demand is still strong, so the price is going to go up. And probably those interest rates, they're probably going to go up in the next 6 months. I can't promise you that next, I mean, really it'll be March, April, May that we got to watch. That's a selling season when it starts.
Right.
January is generally down. February is the getting ready. March, April, May, it starts coming into play. We'll have to see what the interest rates are doing by then, because that will affect a lot of buyers. And what will happen is a buyer who's right on the margin, if the interest rate ticks up a little bit, simply has to either come up with more down payment or buy a slightly less price house. The other thing that's affecting the inventory, you say, well, why are we short on inventory? The home builders, I got to tell you, construction activity in Dallas, as you mentioned a minute ago, in Houston was still leading the world in building single-family homes. Actually built more single-family homes than Dallas did. Dallas built more total residential units because they built more apartments.
Okay.
So that was the trade-off there.
Know that.
So they were 1 and 2 nationally, and they've been 1 and 2 for the last 6 years. For home construction, it still isn't enough. It still isn't enough to satisfy the demand.
Population.
And then we got people that are my age that aren't selling. The average turnover rate used to be for a single-family home 5 to 7 years. You would figure a house would turn over 5 to 7 years. The data now are indicating that's gone to 9 to 12 years. People, particularly the baby boomers, and when I say people my age, the baby boomers, we're in our houses, we're not moving as much as the demographers thought we were going to. We're aging in place. And if we refinanced our house and got 3.5 to 4% money, I don't want to give it up. So I'm not gonna give it up. And number 3, we can't find what else we would like to have.
Right.
The inventory short.
So instead, we go to resort property.
Go second homes resort.
Second home.
Right.
Yeah.
New home construction, I mentioned it there a minute ago. DFW led the country. Houston was number 2, although Houston actually built more single family. You can see the breakdown there and the new home sales were up actually 8%. So the new home sales market was actually
excellent,
very good. Days on the market about 90 days. Months inventory is about 5.1. For the new home market, that 5 months inventory is getting to be about right. The biggest problem in the new home market is the price cohorts. There's actually a glut of new homes that have been built in the 300, 400 price that exhausted the demand and so on. And the builders are beginning to cut back on building the $1 million spec homes and so forth. And that's the reason the median price wasn't, and the average price are not up, or in fact, the average price down slightly, although the price per square foot up nearly 3%. The market slowdown, these are the things I was talking about. People increasing interest rates, the limited inventory, the high prices, affordability is affecting the market. The prices, the last 5 years in Texas, price increases far exceeded income increase. And so the disparity and the ability to buy based on income, people can afford to buy a home about 3.5 times their income. That's what you need to know. You find out what their annual income is, 3.5, and you're in the ballpark of what they can afford. Anything much beyond that, as you approach 4, it's unaffordable. Less than 3.5, they really could afford more unless they have other debts.
It's funny because they always ask in the classroom when we do exactly how to qualify a buyer.
Right.
They're like, do we have to do all this math? What is just a rule of thumb?
3.5. I just said it.
I know. You did. I wanted
I mean,
you to
that's a starting
repeat it.
point. I've even said that in front of the lenders. I've said that to mortgage bankers
Well, lenders
and
use
bankers.
it also.
And they use it. They know. I mean, they'll get into more detail and look at debt to income ratios. We know the student debt level that's been on the millennials has slowed them down and getting into the housing market because they're carrying a fair chunk of change if they've just graduated and have a lot of student debt. So that can be an issue. But these are the factors that just simply may create a drag. And these are those non-economic. A lot of them are non-economic factors. The concerns about the general economy, the fear of a recession. Like Roosevelt said, the only thing we really have to fear is fear itself. Jobs, if you have a job and you've got a good paying job, are you nervous about keeping the job? Well, if you are, you probably aren't going to go out and commit to go buy a house. At least you probably shouldn't.
Sure, you shouldn't.
And then quite honestly, there's a lot of, and just expect to see more, there's going to be a lot of negative press coming up. Some of it's politically driven.
Exactly.
Some of it is because the press really doesn't know what's going on a lot of times. And sometimes it's just people have an agenda or they have a point of view. I can tell you among economists, we talk to economists, and there are some who are very negative, that they think the world's going to go to hell in a handbasket tomorrow. That is not the general consensus feeling, but it happens. So you're gonna hear that and see it. Homeownership rate. This is one I wanted to show you. This is the homeownership rate for households under age 35. There's the millennials coming in, and what has happened is they're beginning to pick up. I only had it through the first quarter, but it's been picking up of the millennials. And as the millennials,
end of the market.
One of the things the millennials have discovered, to their chagrin, is they're getting older. They can't stop it. So where we used to talk about the millennials being 18 to 34, they are now 20 to 38.
They are.
And as you hit those later, the mid to later 30s, they are getting married, they're having families, they're having kids, and they're buying houses.
And they're looking for a home.
Now, there's enough of them that there's strong demand for not only housing in the urban center core, where a lot of them like to live, but also for the suburbs. It's both at the same time. It's not either or. So a lot of the things that you might hear or read is that, well, all the millennials want to live, down inside the Loop, for example, in Houston, or inside LBJ in Dallas.
Not true. They found
Not
the
true.
suburbs have
Not true.
great schools and
It's
great
family life cycle still dictates the kind of house you want to have. You want to have the yard with.
And you're saying they're both growing.
They're both growing.
their
The
rates.
millennials are such a large group of people that you've got plenty of demand for both. And then, of course, the baby boomers, the ones who are moving, a lot of them are going to the rental market. They've had enough with home ownership. I just assumed, but they're looking for high-end rental. They're looking for high amenity, high grade, lock it and leave it to go travel and so forth.
Lock it and leave it.
Right. Annual home sales, you can see 18. We're projecting sales to increase maybe another 2.5% in 19. If the economy holds up like we're expecting it to, 19 could still be another year above, but it won't be a big jump. It'll be, 2.5% increase. Prices probably only going up 3.5% to 4% instead of 4 to 4.5. Little slow down there. The pressure on the prices backing off just a little bit. Here's one of the things I was looking at, whether or not we've actually recovered from the 08-09 recession, is the home sales per 1,000 households. Because, we expect to have a higher volume of sales. We just got more people. Well, as we have more people, we're going to have more sales.
Okay.
So I was looking at it at the rate per 1,000 households. And what you can see is we're selling houses. The transaction volume is really quite high. The average since 2001 is 30.6, and last year was 17. I don't have the 18 numbers yet. It was over 36. You can see the peak there was in 2006 when it went up to 37.6. That was when basically anybody fog a mirror go in and get 110% financing.
That's when we were at the peak of our problems.
That was the peak of the problems, the peak of the housing market. But we're doing extremely well. You can see from 1990 to 2000, during the 90s, which is really viewed as a normal decade, or a stable decade, I should say. The rate was just 20.8, so it's a good 10 transactions per 1,000 higher coming up. Median home price probably going to go up again, but again about 3.5%. Year to date, this is through November. I didn't have the December numbers. When I put the slide together, they just came out last night, as a matter of fact. So some of you may have it in your hand and want to know why I don't have it. I didn't do this last night. I did this a couple of days ago. Was up actually 4.5%. So that's up to almost 50% since 2012 on the median home price. You can see the steepness of those bars since 2011. In some respects, that's where part of that affordability issue, that's almost too steep.
But you're saying you feel like at the end of the first quarter, we're going to see that bar go down.
I think we're going to see it, a little bit. See, we're expecting 19 to be like 3.5 instead of 4.5, or in that ballpark.
Exactly.
And in terms of rates of change, to put it in perspective, I mean, you can see just like the rest of the country in 08, 9, 10, and 11, there was no home price increase. In fact, a couple of years actually the median went down. But then we rebounded very strongly. That's the difference in us and the rest of the country. Our rebound was extremely strong in prices. 18 at 4.5% is almost normal. It's just, remember I was saying we're reverting to norm, and we may go a little below norm for next year. Simply,
we just loved all those.
It's the offset. Norm. Yeah, I know. They always love those above norm. If you own a house, if you're the owner, if you're the buyer, you'd rather have that be a little slower so that you can buy a more affordable house. And here's that spread. The home prices, and the red line, the median home price index to 1989, going up much faster than the nominal household income, which is the blue line in the middle. Real income hadn't moved much at all since 1989.
That's an excellent chart.
Yeah. There's the issue of affordability in a nutshell. And you can see how in the 90s, I was saying that 90s was viewed as a stable decade, how income and home prices were going up kind of in lockstep with each other. But then all of a sudden in 1999, in 2000, home prices started taking off and incomes didn't. Months inventory still low. I mentioned it's been a seller's market basically since June of 2012. If a balanced market is 6 months, and I do balanced market as a range, 5 to 7, or 5.5 to 6.5. So you can see that we're below the balanced market shaded area there.
I have to ask you at this point, because we're very short on time right now.
Yeah.
Where do we need to jump to?
Well, I'm just going to go through quick. Okay. Here's listings. This is the reason we have shortage of inventory. People aren't selling. The listings have fallen off completely, and especially per 1,000. This is per 1,000 of houses in stock.
People are staying in their house.
So people are staying in their house a lot longer and doing this. By price cohort, you can see the month's inventory on the green bars. We're running less than 3 months inventory for the major price cohorts where people are trying to buy a home. Now, at the higher price point, if you're looking for $750,000 or above, you've got some selection.
Yeah, good selection.
You got good selection. I can tell you though that the $1 million plus, that's actually a short bar, relatively speaking. Normally, that's closer to 20, 22 months. So it's interesting. In November, again, I didn't have the December numbers, but in November, you can see Houston and Dallas were down slightly year over year for the month of November. They were up year to date in Houston. Dallas is going to end the year down somewhere around 1.5 to 2%. Basically, I'm going to call it flat, but it's going to be very difficult. Austin is up, flat in November, but up for the year, almost 3%. San Antonio is still running strong. San Antonio, the dark green markets are doing well. You can see Middle and Odessa, that's the hot market right now because of the oil, but I think that's going to fall off because of the fall off in the price of oil. Beaumont and Port Arthur have fallen off as well over there. And then average price per square foot is up on a year-to-year basis just about everywhere. And even where it's orange down there at Laredo, for example, and McAllen, those are just temporary. That's just November data. Single family permits, we're still expecting it to grow almost 10% this for 18 and about 8% in 19. The home builders are running out of lots. They're running out of labor. They can't build houses fast enough because they can't find enough people to build them. They're out stealing each other's labor, what their amounts to.
Exactly. We've heard from our builders that truly does happen.
It does happen. They're out doing. We're still not building enough houses, single family houses per 1,000 new households. This is based on the increase in the number of households each year and how many houses we build. Average is 820. We're building less than that now. Multifamily has been a hot market. That's the millennials, the 20s and 30-something age group came through. There were renters, which is not surprising. People mostly in their 20s, households in their 20s are going to be renters. So we built a lot of rental apartments, but we do think the multifamily is beginning to fade off a little bit. Our construction index, we're nervous about this. The red line there on the bottom, it took a little bit of a nosedive here in the last month or so. You can see the blue line, which is total housing permits, has a little hook on it up there at the top. We'll have to see how well that works out. That's our leading index. So that's what's telling us is going to happen the next 4 to 6 months. Here's some sources of data for your students.
Perfect.
Of where to go. These are not all of them, of course, but I mentioned the demographics for the Texas Data Center, which is the State Demographer's Office, the Workforce Commission for Employment, and of course TAR's Market Viewer. You can get a lot of this kind of stuff. They have a market dashboard. They have the infographics for each market, and there's Austin and Dallas, and then there's Houston and San Antonio. And then to end this, I know I'm running out of time. We're going to have to learn how to live in a world of rising interest. We're going to go back up with, you're going to have younger and inexperienced buyers to have to work with. As the millennials and the first-time buyers come into the market, they're younger, they're inexperienced, they've generally got definitive ideas about what they want and how they want it and so forth, but you're going to have to learn how to deal with that. You're going to have selective, limited inventory available. Changing loan, the lending is changing. The lenders are trying to make mortgage loans easier to obtain. The regulators are trying to make them harder to obtain. It's a real battle going on, and the underwriting requirements and standards, they seem to change almost daily or weekly of what any given lender is doing and so forth. And then the pricing of estimating what to list a house for and what a good sales price is going to be a challenge. Right now is a really difficult time to be an appraiser.
It is.
It's a really difficult time to be an appraiser. And the pricing issues and the local pricing is really, really going to be difficult. And I appreciate very much.
Thank you for the ad you put on the top of your economic PowerPoint there. Oh my goodness, Dr. Gaines, we never have enough time for you. We love the information. He does it with such excitement, enthusiasm, explains it like an instructor. And thank you so much for being here to kick off our year.
My pleasure.
We want to see you back mid-year. And as I was telling Dr. Gaines this morning, we use this wonderful presentation in all of our CE classes around the state for the year. And then mid-year, when we have the new update, we invite you back. I hope you can be here. Then we'll use that one for the last 6 months of the year. In a couple of weeks, we're going to change the theme somewhat, in that we have Mattress Mac Gallery Furniture, who will be our speaker. He'll be here for an hour, January the 24th. For those in the Houston general region of 4 or 5 counties, we know about Mattress Mac because he is such an entrepreneur. He helped so much during the Harvey, opening his wonderful gallery furniture stores for people who were dislocated and needed a place to take their families. Not only did he open his stores for them to be in, he gave them food and water and a reason to get up in the morning, entertainment for the kids, and He is most definitely one of our hometown heroes in the Houston area. He will be speaking on 10 successful steps to being the best entrepreneur you can be. I heard this on public radio, or public TV rather, PBS, and got in contact with him, asked him if he would do it free for our students around the state, for our wonderful customers around the state. So mark your calendar, go to our website, championschool.com, and get the link so that on January the 24th, for 50 minutes, you will hear an amazing entrepreneur on 10 steps to being the best entrepreneur you can be. Our new catalog will be out. The digital copy is out this week, and we have all of our superstars lined up for the rest of the next 7 months. They give you their secrets to success, and you learn so much that helps your business. We do this because Champion School of Real Estate invest in your career, your success. It's all free. We thank you for being one of our wonderful customers in real estate, loan, appraisal, inspection, and business etiquette, and we can't wait to see you again, Dr. Gaines. Say hello to all of those wonderful people at the Real Estate Center at Texas A&M University. Thank you. Have a wonderful rest of the month.